3 years ago, a guy named Tom finally decided to get serious about his financial future. He didn't want to day trade, and he definitely didn't want to spend his weekends reading boring corporate earnings reports. So he did exactly what every financial guru, best-selling book, and wealthy uncle tells you to do. He set up an automatic transfer of $500 a month into a standard S&P 500 index fund. Every time that transfer went through, Tom felt a deep sense of relief. He slept perfectly fine at night with calm confidence. Why? Because he pictured his $500 being sliced into 500 tiny, equal pieces, spreading his risk across the biggest and most successful companies in America. If one company went bankrupt or an entire industry struggled, Tom knew the other 499 companies would easily catch his fall. He felt completely bulletproof. But if Tom actually opened the hood of his index fund and looked at the brutal math running in the background, that calm confidence would vanish immediately. Tom is standing on a hidden mathematical trapdoor. He doesn't realize it yet, but his perfectly safe, heavily diversified portfolio is actually a massive, highly concentrated bet on just a handful of technology companies. This isn't a story to scare you out of the stock market, and it's definitely not a pitch for some risky trading strategy. It's a story about the hidden math running inside the world's most popular investment vehicle, math that Wall Street happily ignores while everyday earners take on all the risk. For the last 15 years, the advice to just buy the index and chill worked flawlessly. It was the ultimate life hack for building reliable wealth without needing a degree in finance. But by early 2026, the structural math of the market had fundamentally shifted. The system originally built to protect you through wide diversification has quietly mutated into something entirely different. When you put your hard-earned money into a standard index fund today, you are not buying a little piece of 500 companies equally, not even close. There is a silent mechanic controlling your portfolio right now, and I call it the $40 out of $100 rule. Imagine you walk into a bank, hand a fund manager a crisp $100 bill, and ask them to spread it across the 500 best companies for you. You would naturally assume they put about 20 cents into each company. That is what true diversification means to the average person. But that is not what actually happens with your money. Instead, that automated system takes your $100, rips off over $40, and hands it directly to just 10 mega-sized technology companies. Then it takes the remaining $60 and thinly spreads it across the other 490 businesses. You are not truly diversified. You are incredibly top-heavy. Your financial future is not resting on the broad, strong shoulders of the entire American economy. It is resting almost entirely on the shoulders of a few Silicon Valley billionaires. And the most dangerous part is that you are doing this on complete autopilot every single month, buying more and more of those top 10 companies regardless of how expensive their stock prices get. To understand exactly how we got into this massive blind spot and why it puts your long-term stability in jeopardy, you have to look at the silent engine that drives these funds, a system known as market cap weighting. Market cap weighting sounds like a complex term from an advanced finance textbook, but it is actually just a simple popularity contest. Let me explain how it works with a real-world example that you see every time you go to the store. Imagine you are buying a giant basket of groceries for your house. In a normal world, you would look at the price of milk, bread, and eggs, and you would decide how much of each you need based on their actual value and what your family consumes. But in a market cap-weighted system, you don't look at the real value at all. You just look at the price tag. If the price of the milk doubles tomorrow, the automated system forces you to buy twice as much milk, simply because it got more expensive. You are buying more of it purely because it costs more, not because the milk suddenly got better or because you need it. That is exactly how your index fund operates right now. The bigger a company's stock price gets, the larger its total size or market cap becomes. And the larger its market cap becomes, the more of your monthly $500 investment the index fund is mathematically forced to push into it. It does not check if the company is making a good product. It does not check if the company is badly managed. It only checks the size. My experience sitting with financial analysts and looking at institutional data has shown me a reality that everyday earners never see. In the financial industry, experts are calling what is happening right now the great narrowing. Back in the day, the S&P 500 was a relatively flat playing field. But today, because of this automated buying, those top 10 tech companies have become so massively expensive that they eat up roughly 41% of the entire index. Now, you might be thinking that if they are the biggest companies in the world, they probably deserve the most money. That makes complete logical sense, until you look at the actual profits these businesses bring in. This is where the math gets brutal. We call this the earnings disconnect. Those top 10 companies might take 41% of your investment dollars, but they only generate about 32% of the actual total profits out of the 500 companies. Let that sink in for a second. You are paying for 41% of the pie, but you are only receiving 32% of the actual nutritional value. You are severely overpaying for the popular kids in the class, while the other 490 companies, many of which are quietly generating solid, reliable, and growing profits, are being almost entirely starved of your investment capital. This creates a highly dangerous loop of blind money. Every 2 weeks, when paychecks clear across the United States, automatic deposits hit Vanguard, Fidelity, and Charles Schwab from millions of retirement accounts. Billions of dollars blindly by those top 10 tech giants at whatever price they happen to be trading at that morning. Nobody is checking if the company is actually worth that premium price tag. Nobody is looking at the actual business fundamentals. The machine just buys. And because the machine buys, the stock price goes up. And because the stock price goes up, the machine is mathematically forced to buy even more of it next month. It is a mechanical cycle that pushes the prices higher and higher without any connection to reality. And when the price of an asset completely detaches from its actual underlying value simply because a blind system is forced to keep buying it, history tells us that we are stepping into very familiar and highly unstable territory. Many of the most successful investors alive today are looking at this exact automated loop and seeing the ghost of a crisis we all thought we left behind. If that sounds slightly terrifying, you are not the only one seeing the warning signs. Dr. Michael Burry, the famous investor who accurately predicted the 2008 housing crash, has looked at this exact blind buying cycle and issued a massive warning. He compared the current rush into passive index funds to the exact same behavior that caused the entire 2008 financial crisis. Back then, Wall Street took hundreds of bad home loans, packaged them together into one shiny box called a CDO, and put a safe 5-star rating on the outside. Investors from all over the world bought that box. They didn't look inside. They didn't check if the everyday people holding those mortgages could actually pay their bills. They just trusted the package because it had a safe brand name. When the loans inside the box started failing, the entire system collapsed because nobody had actually checked the math. Burry points out that index funds are doing the exact same thing right now. An index fund is just a shiny package holding 500 different stocks. When you buy the S&P 500, you are not checking the health, the debt, or the actual value of the companies inside. You are just buying the package because everyone online tells you it is safe. It is completely blind money. You are trusting the brand name of the index, completely ignoring that over 40% of that box is heavily stuffed with just 10 highly expensive tech companies. And Burry is not some isolated guy wearing a tinfoil hat. Even the literal inventor of the index fund saw this exact problem coming. John Bogle created the first index fund back in the 1970s. He founded Vanguard and is widely considered the godfather of passive investing. But shortly before he passed away, Bogle looked at how massive his own creation had become and issued a clear warning to the public. He stated that if passive index funds ever grew to control more than half of the entire stock market, it would completely break how the market is supposed to work. He warned that having too much blind money would destroy the system's ability to actually price businesses fairly. Today, passive funds and ETFs make up roughly 60% of the United States equity fund market. We have officially crossed the exact red line that the inventor of the system warned us about. When you have 60% of the market just blindly buying everything on autopilot every single month, it removes basic human common sense from investing. Think about it like driving on a massive multi-lane highway. In a normal market, you have millions of drivers looking at the road, checking their blind spots, tapping the brakes, and avoiding potholes. If a company is doing badly, the drivers steer away from it, pushing the price down. If a company is doing well, they steer toward it, pushing the price up. That is how the stock market is supposed to find the true, fair price of a business. But today, 60% of the cars on that highway have the windows blacked out and the cruise control permanently locked at 80 miles per hour. They are not looking at the road. They are not looking at the signs. They are just following the car in front of them, trusting that the automated system will somehow keep them safe. But what exactly happens when the road suddenly turns? What happens to your retirement money when all those automated cars are forced to hit the brakes at the exact same time, but nobody is actually holding the steering wheel? When everyone hits the brakes at the exact same time, you encounter something called the liquidity trapdoor. This is the exact moment where the math of passive investing flips from being your best friend to your worst enemy. Think about a crowded theater. If the fire alarm goes off, every single person in the room runs for the exact same exit door at the exact same time. Now apply that to your index fund. If a major economic event happens and millions of regular people log into their retirement accounts and hit the sell button out of panic, the automated index fund does not think, it does not check if those massive tech companies are still making good products. It is mathematically forced to sell huge amounts of those top 10 companies immediately to give you your cash back. But here is the catch. For you to sell a stock, someone else in the market has to actually buy it from you. In the past, when index funds were just a small slice of the pie, there were plenty of active human managers waiting at the bottom to buy those stocks at a discount. But today, because passive funds control 60% of the entire market, there are simply not enough active buyers left to catch all those falling shares. The automated machines are all trying to sell at the exact same time, and the human buyers step back and refuse to buy until the prices drop drastically. The floor simply vanishes. The price falls straight through a trapdoor, causing your portfolio to drop much faster and harder than it would in a normal, healthy market. Two famous economists named Grossman and Stiglitz actually figured this out decades ago. They proved a very simple rule about human behavior. Imagine a classroom where one student always studies hard and gets an A on every test. Eventually, the other students realize they can just copy his answers and also get an A without doing any of the hard work. That is exactly what index investing is. You are copying the market's homework. But the economists pointed out the ultimate flaw. If every single student in the room decides to just copy the answers, absolutely nobody is actually reading the textbook. And if nobody is reading the textbook, the entire class eventually fails. When everyone just buys the index, nobody is actually doing the hard work of figuring out what a company is truly worth. The market becomes completely inefficient. The prices of those top 10 tech companies are currently pushed up to the sky simply because everyone is copying the homework, not because they did the actual math on the business. But the instability of a future market drop is only half of the problem. What your money is doing right now today is equally concerning. Because the automated system is completely blind, it doesn't just push your money into the biggest tech companies. It also forces your hard-earned paycheck to actively fund the walking dead. Let me explain what a zombie company actually is. In a normal, healthy economy, if a business makes bad products, takes on too much debt, and stops making a profit, it fails. It goes bankrupt. That is how the system is supposed to clean itself out. But right now, there are dozens of companies inside major index funds that do not make enough actual profit to even pay the interest on their own loans. They are mathematically dead. They should be out of business. But they are not. They are the walking dead, kept alive by a continuous, artificial drip of cash. And that cash is coming directly from you. Every time you buy a standard index fund, the automated machine does not have a brain to say no. It cannot look at a failing company and decide to skip it this month if a company is listed. In the index, the machine is mathematically forced to buy it. So when your automatic deposit hits your account, a small piece of your hard-earned money is taken away from funding good, profitable businesses and is forced into buying the stock of a dying company. Think about how frustrating that actually is. You wake up early, you work hard all week, you budget your money carefully, and you try to make responsible choices for your family's future. But because you are using a blind, automated investing system, a piece of your responsible savings is actively bailing out highly irresponsible CEOs who ran their companies into the ground. You are personally subsidizing failure. If a friend came to you and asked to borrow $1,000 for a business that hadn't made a profit in 5 years and couldn't even pay its credit card bills, you would laugh and say absolutely not. But your index fund is saying yes to that exact same deal on your behalf every single month without ever asking your permission. This breaks the fundamental rule of how wealth is actually built. You build wealth by owning pieces of highly successful, growing businesses. When you force a system to buy everything, regardless of quality, you drag down your own long-term returns. You are carrying dead weight in your portfolio, and right now carrying that dead weight is more dangerous than it has been in over 2 decades, because the price you are paying to hold the entire market has reached a historical breaking point that most new investors have never seen before. That breaking point is a specific math calculation called the Shiller P or E ratio. Let me explain it using a simple lemonade stand. If you want to buy a neighborhood lemonade stand that makes exactly $1 a year in profit, how much would you pay for the whole business? A normal person might pay $15 or maybe $20, knowing it will take them 15 to 20 years of profits to get their original money back. That is exactly what a normal, healthy stock market looks like. But in early 2026, the Shiller P or E ratio for the stock market crossed over 40. That means when you buy a standard index fund today, you are currently paying $40 just to get $1 of actual profit. You are buying the most expensive lemonade stand in modern history simply because the automated machine forces you to stand in line and buy it. When the price tag gets this insanely high, history gives us a very brutal warning. We have seen this exact setup before, and we know exactly how the math plays out. Go back to the year 2000. The stock market was heavily concentrated at the very top, exactly like it is today. A few massive technology companies completely dominated the index. Regular people were pouring their paychecks into the market every single month on autopilot. They ignored the crazy high prices, fully believing the new tech companies would just keep going up forever. Then reality hit. The math caught up with the hype, and for the next 10 years, from the year 2000 all the way to 2010, the standard S&P 500 returned exactly 0%. Think about how painful that actually is. Imagine putting a portion of your hard-earned paycheck into an index fund every single month for 10 full years. You skip vacations, you drive an older car, you budget your family's life tightly, and after a whole decade of discipline, your investments have made absolutely zero profit. Financial experts call this a lost decade, and the mathematical conditions that caused that massive lost decade in the year 2000 are almost identical to the exact conditions your index fund is automatically buying into right now. But it actually gets a little bit more difficult for today's investor. Over the last 40 years, index funds had a massive hidden advantage. Interest rates were constantly dropping. Imagine riding a bicycle down a very long, steep hill. You barely have to pedal and you just keep going faster and faster. That downhill slope is exactly what declining interest rates did for the stock market. It made borrowing money extremely cheap for businesses, which made their profits look artificially amazing. It made the entire stock market and index funds look like pure magic. But today, that long hill is completely gone. The 40-year cycle of dropping interest rates has mathematically ended. You are now trying to ride that exact same bicycle on a flat road, and sometimes even slightly uphill. The easy money is over. The wind is no longer pushing the market forward when you combine the most expensive stock market prices in history with a top-heavy concentration of just 10 tech companies, and you remove the downhill advantage of cheap interest rates. The standard index fund transforms from a wealth-building tool into a wealth-trapping trap. But you do not have to be trapped inside of it. You do not have to pay expensive fees to a Wall Street manager to protect your retirement, and you certainly do not have to sell everything and hide your cash under a mattress. There is a very simple, highly effective mathematical solution hiding in plain sight that instantly fixes this massive imbalance. That solution is called equal weighting, and it completely removes the blindfold from your investments. Let me go back to that $100 bill you handed the bank manager. In the dangerous, top-heavy system you are currently in, they gave $40 to just 10 companies and starved the rest. But what if you forced the manager to play fair? What if you told them to take that $100 and give exactly 20 cents to every single one of the 500 companies, no matter how famous or how big they are? That is exactly what an equal weight index fund does. It treats the biggest trillion-dollar tech giant and the quiet, boring utility company with the exact same level of respect. Every single business gets an equal slice of the pie. When you change the rules of the game to equal weighting, the math instantly flips in your favor. You are no longer blindly buying a stock just because it got expensive. In fact, it does the exact opposite. If one of those tech companies has a massive year and its stock price shoots up to the sky, the equal weight fund actually sells a little bit of it to lock in your profit. It then takes that extra cash and uses it to buy the quiet companies that are currently on sale. It automatically buys low and sells high for you, completely removing the dangerous cycle of overpaying for popular stocks. More importantly, it completely boards up the trap door. If a major economic panic hits tomorrow and those top 10 tech companies crash hard, your retirement account does not get wiped out. Why? Because those 10 companies only make up a tiny fraction of your money, not a massive 40%. You are actually protected by the other 490 businesses that are still generating solid profits, paying dividends, and keeping the actual economy running. This completely redefines what true diversification actually means. Real diversification is not just holding 500 names on a piece of paper. It is making sure your hard-earned money is actually spread out evenly across different industries, different business sizes, and different risks. When you fix this math, you regain something incredibly powerful called financial optionality. You are no longer tied to the panic and the extreme valuations of a few Silicon Valley billionaires. You are actually investing in the broad, strong foundation of the American economy again. You can sleep at night with actual calm confidence, knowing your money is not sitting inside a fragile, highly concentrated bubble just waiting for the wind to change. My experience looking at these market cycles has shown me that the everyday investors who survive the lost decades are the ones who truly understand what they actually own. They do not just follow the crowd blindly because a book from 20 years ago told them to. They look at the math of today, they adjust their sales, and they actively protect the money they sacrificed so much to save. You can take action on this immediately. This week, log into your retirement account and actually look under the hood of your funds. Check the top holdings. If you see that 30% or 40% of your life savings is sitting in just a handful of tech stocks, you now know the hidden risk you are carrying. You can choose to leave it there and hope the bubble never pops, or you can choose to balance the scales. You can slowly move some of your future deposits into an equal weight fund, or find funds that specifically focus on reliable, profitable companies instead of just the biggest ones. The choice is entirely yours, but now you actually have the math to make that choice with your eyes wide open. You are no longer driving blind on the highway. You are finally holding the steering wheel. If this breakdown helped you see the truth about your money clearly, make sure to subscribe to Emma Invests. We break down these hidden market trends and wealth-building strategies into simple, undeniable steps so you can take full control of your financial future without getting scammed by the system. Stay safe with your investments, and I will see you in the next one.